Hey, what's up everybody? Zach is back with another episode of Journey to $1 million, and we're getting further and further away from our goal as the stock market keeps slipping. Let's go ahead and jump right into it, but overall, S&P is down 2.4% today, NASDAQ is 3.5%, Dow Jones is 1.75% down. So that is kind of a lot. Let's look at the charts a little bit for NASDAQ. This is triple Q. QQQ seems like it's somewhat holding this support that I've drawn out, although not very well. It's below the 50-day moving average now, so we are looking more along the lines of the September-October corrections. I'm assuming that it would be closer to the September correction now, when the triple Q slipped from, well, hold on, let me change my chart settings back really quick. Sorry about that. Slipped from about $300 down to $260. So that is about 13%. So I think we're looking at something like that right now. And it took from the September 1st down to September 25th, so it almost lasted a month before, like going down for a month before it started bouncing back. So far we're at from the 16th, now the 25th, so we could have a couple of more weeks coming here. But if we go over to the 4-hour chart on the triple Q, we are a little bit below the support, although cannot really say if this support is going to hold or not. But it's basically taking the slope of incline of the normal market conditions, in a bull market that we've seen, and dragging down this slope to these supports right here. But you know, we'll see if it holds. I wouldn't be surprised if tomorrow we're going to be a little bit flat. Although hopefully it's Friday. Hopefully we can see a bounce like we did the previous Friday before the weekend. So we're just going to have to wait and see, but overall I think we could possibly here. Also, the S&P is on this support as well, and this is the support actually from the January 26th and also the one in October, that is. So we will see. Yep. We're just going to have to see, but anyways, we're going to keep dollar cost averaging into our longer positions. And this is why I said that it's going to be best to not have the short-term or mid-term options right now, because you're just going to get killed on the decay. And I had cut mine on, I think it was Tuesday. Yeah, I'm pretty sure it was Monday, Tuesday. I went ahead and cut mine, moved it into hedges, which the hedges are not doing very well, and I'll have to show you guys that, which is a little bit surprising, but if you think about it, kind of makes sense. But yeah, I went ahead and cut my short-term and mid-term options because you're just going to get killed on the decay, because we don't really know how long it's going to take before the market goes back to normal and recovers from this dip. So anyways, let's go ahead and look at these hedges that I'm talking about really quick before we go over the new watch list. And if you don't already have this pulled up, go ahead and go to prostockadvice.com and /blog, and then go ahead and pull this report up so you can follow along with me. But anyways, let's go over to my options positions. Yeah, I'm down 13% today, guys, so it's pretty bad. But let's see, these hedges that I had, the SMH and the XLK, they didn't go up. As a matter of fact, they kind of went down a little bit today. So and these are puts. And granted, let's look at the XLK one. Granted, they're pretty far out, and they're literally the furthest out in strike and expiration date. Pretty much that we could even buy. But let's take a look at it. Switch this over to single option, go out. For the puts, I have these positions right here, January 21st. So I mean, it's basically this one right here. So even with the market, okay, so the underlying fell 3.5% during market hours. And then this put fell 20%. So I mean, okay, that didn't really go as planned. But I think it's going to be just too far out with too little volume. I mean, if we go up here, Let's just look at a 91, for example. This one came up by only 4%, and these not even really moving. So the volume is just way too low. So we're going to have to rethink that a little bit. But I've got limit orders to sell those just in case it does bounce. And the last few days, they were bouncing up and down because it obviously was up since we bought them when it initially started falling and selling off. So, I mean, it's not like they will never go up. They were up, and that's when we bought them, thinking that this is mitigating risk a little bit with this hedge play. But anyways, those are not going very well right now, but we'll see. If they do bounce up a little bit now, we're going to start selling them off and rethinking the hedge play since it's not really working for us right now. But anyway, so we'll see if it takes, see how long it's going to take. I'm not going to be surprised if we see a little bounce today. And currently I am looking at futures. Let me just pull this up. Yep, currently I'm looking at the futures. Seems like Dow is going up about 0.33% right now. This is on the 1 hour chart. S&P is 0.3%. So guys, if you're interested to know what platform this is, you can go ahead and send me a message and I can give you a link for it. But in NASDAQ is up 0.16 for the future. So I'm going to be watching these today and see if it can come up a little bit, but I'm not really going to be surprised if it doesn't. It could be flat, because it is Friday, so people might sell off even more. But if they do, if it is flat or if it drops a little bit more for Friday, then I would expect to push on Monday. I mean, I still don't think this is the beginning of a market crash, because we're still not even as bad as it was in September and October dip. But in September was more of the shift into the value stocks, like what we're seeing right now is similar. But nevertheless, let's go ahead and check out two that I'm adding to my watch list. And these were actually from the live stream last night. So if you're not subscribed, go ahead and subscribe and turn the notifications on. And while you're down there, go ahead and smash that like button. It really does help me out, especially these days. I'm down pretty decent amount, so it's really gonna make me feel better if I can get some more likes and some more subscribers during this time, during the time of mourning my wallet. But nevertheless, the first one I want to check out is Materials Corporation. This is a producer of rare earth minerals and elements that are critical in the production of magnets that enable the mobility of electric vehicles, drones, defense systems, wind turbines, robotics, and many other high-growth advanced technologies. So that's interesting, and this one has seen some growth. It's going down the last day, but actually it's been up since the start of this dip. So it's interesting, and this is right up my alley because it's important for the robotics, which is like ARC-Q, EVs, which we have a lot of, clean energy, which I'm waiting to see how low it goes before I make any plays. Once the market starts recovering from the dip, then I would be more interested in getting into some longer term positions in the clean energy. But we do have a renewable energy of Reggie right now. But anyways, I'm very bullish on this overall, and even though there's a transition right now into the value stocks away from the growth stocks, for me it just means it's time to buy them more. So dollar cost averaging into the longer term positions, mostly interested in ARC right now. But once it does show signs of recovery from this dip, then I would be interested in picking up a lot of these different ones. But I'm staying away from short to midterm options as of right now. So target price for MP I set for around $60. I don't think that's all that high. This should see a decent amount of growth. The entry price is less than 40, which is pretty much what it is right now. I'm just going to dollar cost average all the way down to the support. And risk, I put a 4 time frame, 5 to 8 months. I'm not in any rush for this at all. But let me know what you guys think about MP. And then the last one that I want to add to the watch list is DocuSign. So obviously DocuSign is going to benefit, or it has benefited from COVID-19 and the lockdowns, and more people are just want to sign electronic documents. And this is not going to go anywhere, because if you ever had to print, sign, and scan something, you know it kind of sucks. Like why do you want to do that when you can just sign electronically? No matter if it's in real estate or insurance or anything like that, we can just sign electronically, which I've done a lot of last year. So I personally have used it and I like it, and it's just awesome. It's kind of like my experience lemonade. It's just so much better than the traditional. But nevertheless, it's right now the technicals look the most intriguing to me. It's approaching the 50, 180 day moving average. The 50, 180 day moving average are approaching together. They're getting pretty tight here, and if you see the last time they squeezed together, we did see a little pop, and it's been in the parallel channel since July. So this one is pretty interesting. Right now we're at support. This could be an easily swing up and down type of trade. So possibly get some short to midterm options on this one. But again, I'm going to wait until that if everything just chills out a little bit. Then we can start talking about some of the more short-term plays. And that's just my style of trading. I just take a more conservative approach. I spend most of my money right now that I have available, which is usually around 15% cash. I'm going to spend most of that on dollar cost averaging my more quote-unquote important positions, like my longer term or my leaps. But it is what it is. Target price $300, entry $225, which is pretty much what it is right now. Risk is a 3. This is not going anywhere, guys. Time frame 3 to 5 months. Well, anyways, keep in mind the risk is 1 out of 5. 1 is the least risky, 5 is the most risky, and kind of go ahead and weigh the positions based on those, I would say. But another thing that I wanted to talk about really quick were which this question actually came up in the Discord. It was about the drag on the 3x leveraged. So this is TQQQ. Let's go over to the day. Now let's take a look at this. We want to, and this is the March low. Okay. So let's just get this right, the end of the chart on the left. Let's get it right up until the March low, just to have a reference point. So let's just say, and I want to switch my chart settings over to percentage. So let's say this is actually up about what, 310% since the March low-ish period. I don't know if I timed that exactly right, but since the beginning of this window here on the widget for the chart, it is up 310% about, let's just say. So if we get our calculator out, this is the TQQQ, so just the normal QQQ should be up, well, divided by 3, 103%. And actually a little bit more, since there is some drag. Well, you know, theoretically there is supposed to be some drag. That's what everybody talks about. That's what everybody warns you about, not to get involved with the 3X's long term. Okay, so let's go ahead and look. So we're thinking around 100% then, right? If this is 300%, the normal QQQ should be up 100%, right? Since the beginning of this chart. So let's go over here to the QQQ. And let's see, yep, so it's still in the same spot on March 19th. And it's only up 73%. So as you can see, that doesn't actually work some of the times like you would think it is. So if you do the math, I did the math, it is about 4.5% X on the TQQQ. Now, that's based on the past performance, which doesn't necessarily indicate future performance, but you take it as you will. I'm just letting you know, guys, there is no drag on these. And the TQQQ and the SOXL, they are performing more than 3X. I mean, we can do this same little case study on the SOXL, which is one of my favorites, even though it's down like a lot today. But it's holding the 50-day moving average. So, I mean, and this is even the 3X, which is not actually 3X, it's more, but let's see. So let's just go over, find a reference point. This is March 19th, I believe. March 18th, okay. So it is up since March 18th about 750. Let's just say 750, 760. So if we pull out our old calculator, so let's just say 750. And if we divide that by 3, so the normal 1X should be up 250. So let's just go over to the normal 1X, which is either SOXX or SMH. Okay, doesn't matter. We can try SOXX first. So where's our calculator? Remind me here. So it should be 250, and it is actually only up 135. Okay, so it was 750, right? Yeah, the SOXL was up 750, and if this one is only up 135, so that's actually a 5.5x. So there is no drag, because if the 1x is up 1x, it's up whatever x percentage, then let's just say 100%. Then the 3x version, including the drag, it should be less than 3x. It shouldn't actually be. Because if you think about it, what we're talking about is, let's do an easy example. If let's say the price is $100 for the normal 1x, and then it drops, let's just say it drops to $90, so that's 10%. But to come up, now the price it dropped 10%. So the price is $90. Now, so then if you want it to come back up to 100, so up another $10, back to 100, back to recover from a dip. So it's going to be 10 divided by 90. So it's actually going to be a little more than 11% to get back up. You see what I'm saying? But on the 3x, it's going to be exaggerated. And this is where the drag is going to come in handy, because let's say the 1x version dropped 10%, so that means the 3x version should drop 30%. All right, so let's say it's also, well, that would make it, what, $300, because it's the 3x, but that's not necessarily true. Let's just say $100 on the 3x, just to keep the math simple, and then it drops, it should drop $30, right? So that would put it down at 70. But then if you want to come back up to your 100, it would be 30 over 70, which would actually be 42%. So a drop of 30%, it's going to then take it 42% to get back. But you see, the 1x is only up 11.1%. So it was 0.111 to get back. So if the normal 1x goes back up to recover by 11.1%, the 3x should only be going up by 33.3%. So if we do 33% times, the 3x fell down to $70, right? So it's actually going to come up to $93. So that's the point on the drag. So once the 1x one actually recovers from a dip back to $100, the 3x one still is going to be around 7% short. I mean, that's the point with the drag. But in actuality, for the past performance, there is no drag. These are up. The TQQQ was up 4.5%, or sorry, 4.5x more, and not 3x. It was up 4.5x, and then the SOXL was actually up 5.5. So, take it with a grain of salt. Do your own research. Do your own homework. But yeah, there's not really drag. But of course, going forward in the future, that could change. But just going based off of 2020, and I mean, you can take these back to the week graph, and I mean, we can do the week graph. It doesn't matter. It's just way back if you want, or even a month. And you can just go way back from the very beginning of time and do your homework on this to calculate, is there any drag? And how much is it actually up? But yeah, pretty much that's the point for the drag. So let me know what you guys think about that, and if you're invested personally in the 3x ETFs, like I am, for long term, even though pretty much the entire internet says don't do that, but it's worked out well for me, and there is not really any drag. And it's more than 3x. So let me know what you guys think. Go ahead and follow me on Twitter. Subscribe to the YouTube. Hit the like button. And if you want to know what platform I'm trading on, it is Webull. Find the link in the description for couple free stocks. One could be Facebook and Google right now. So go ahead and check that out. But anyways, guys, I will see you guys on the other side. Peace.